The purpose of this webinar is to share collective data and insights from the 9 CSAF members on the evolving credit market for small and medium-sized agricultural businesses or agricultural SMEs, and what it will take to unlock capital for much greater scale and impact. Today's discussion is a preview of the CSAF's forthcoming annual report, which will be available next week. And we're thrilled that so many of you have joined us today. At last count, there were 140 registrants from 25 countries and a range of stakeholder groups with a vested interest in agricultural finance. For today's agenda, first I'll provide background on CSAF's origins, objectives, and key takeaways from our collective learning. Next, Blaine Stevens, who is the Chief Operating Officer for our data partner Mix, will share more detail regarding 2015 lending activities. Then Karina Torres, who is the Agricultural Technical Advisor for another CSAF member, Oico Credit, based in Peru, which is the largest market where CSAF members lend, will ground the data in her experience in South America and will present our outlook for the market. And finally, Dan Zook, who is Director of Investments at the Initiative for Smallholder Finance, will share his perspective on how dynamics in the CSAF lending market relate to trends across the broader smallholder finance industry. And we'll save about 20 minutes for Q&A at the end. Okay, so what is CSAF and why does it exist? CSAF is an alliance of 9 institutions financing high-impact agricultural SMEs in Africa, Asia, and Latin America. These businesses work directly with smallholder farmers, purchasing crops from hundreds or thousands of individual producers, and then aggregating, processing, and selling those crops to domestic or global buyers. Businesses include both producer organizations such as farmer cooperatives and private enterprises like food processors, whose credit needs tend to fall in the $100,000 to $3 million range. 7 of the institutions that now comprise CSAF first met together in 2012. New players had begun entering the market, and there was growing interest in the agricultural missing middle. That is, businesses too large for microfinance but unable to access credit from local banks. Agricultural SMEs in the missing middle were and continue to be one of the last frontiers in financial inclusion. We agreed that serving this market thoroughly and effectively could create enormous impact on the livelihoods of millions of farmers and enterprise employees, as well as in local communities and the surrounding ecosystems. It could also benefit food security and climate change at a national and global level. But we also recognize that growing the market irresponsibly by over-indebting borrowers or financing exploitation of natural resources, for example, would be worse than not serving the market at all. 4 years later, CSAF is still not a legally registered entity, and we have no plans to become one. We do not have a secretariat or full-time staff. We operate on a lean budget that covers the costs of compiling data and learning for this report and supporting 3 work streams that I'll outline in a moment. We're first and foremost an alliance of practitioners making loans and in some cases providing technical assistance. We're also competitors who jockey for position in certain markets and with larger borrowers where we overlap. But we recognize that the potential market is enormous and largely untapped, that the risks in agricultural lending are many, and we're usually better off sharing them than going alone. And most importantly, that our collective efforts will never be sufficient to address the demand directly. So if we are to achieve our ultimate objective of a thriving, sustainable, and transparent market, we must collaborate to exchange our learning and, over time, work with others to develop industry standards and best practices. Our 3 work streams include, number 1, market growth to address a larger portion of the unmet need, and we view this effort to share data and learning, warts and all, as critical to attracting more partners and competitors, especially local financial institutions. Number 2, responsible lending practices. We have developed and posted on the CSAF website a set of principles to which all members adhere, and we regularly discuss how to apply those principles in practice. And number 3, social environmental impact, because we do not assume that increased lending activity will necessarily contribute to positive social and environmental outcomes. We're currently working on a set of principles to formalize social and environmental standards for our lending, and we're collaborating on training and due diligence tools for our loan officers to implement these standards. Under the header of market growth, we believe that access to reliable data is critical for guiding decision-making by prospective borrowers, lenders such as ourselves and upstream investors. Producing timely, accurate, and comprehensive data is no small feat, and we are the first to recognize that CSAF efforts in this area leave ample room for improvement. This is the third year that CSAF members have aggregated our portfolio data to present a snapshot of our segment of the market. And we want to emphasize that we represent only one part of the expanding agricultural finance sector. The inflection point report that Dan Zook will speak to in a moment provides a more comprehensive overview of the market. And we would like to welcome to the call several of our colleagues from institutions that do direct lending to farmers, and that earlier this year launched a coalition for that segment of the market called Propagate. We can imagine a future state where different subsegments of the agricultural finance market, equity investors, equipment leasing companies, crop insurance providers, have their own alliances, much like Propagate and CSAF, to develop standards and best practices for their market niches, and where we all come together under a single umbrella entity to share data and learning. But that's still a few years away. So in the meantime, let's get to the findings. CSAF lending over the past 2 years provides a glimpse into both the market opportunity and the challenges of meeting the demand for smallholder finance at scale. Our collective lending has far surpassed the $500 million milestone we set back in 2013 and hope to achieve by the end of 2016. Last year, the 9 CSAF lenders dispersed a combined $597 million in short and long-term loans to 672 businesses across 66 countries. These businesses, in turn, generated $3.7 billion in combined annual revenue and helped to connect an estimated 2.1 million smallholder farmers to local and global markets. And Blaine will talk in a moment about specific growth trends at the crop and regional level. But 2015 was also a year of slower growth and increased risk for many lenders, not to mention the agricultural businesses we finance and the farmers they reach. On a global aggregate basis, the top-line lending figure of $597 million represents a 5% increase in credit dispersed compared to 2014. Not bad for a more mature market, but a considerable slowdown from the 64% growth observed in 2014. A range of challenges underscored the vulnerability of smallholder farmers and agricultural SMEs to forces beyond their control and increased risk for CSAF lenders. Leading risk factors include, number one, low prices of several agricultural commodities, particularly coffee, which is the leading crop financed by CSAF members and accounts for almost half of all lending. Second, crop failure, most notably but not limited to coffee leaf rust disease in Latin America. Crop failure linked to extreme weather events and climate change both increases risk for our outstanding loans and presents obstacles to reaching new borrowers. Third, emerging market currencies depreciated significantly against the U.S. dollar. Ghana's cedi depreciated by 30% in 2015, and several other currencies across Africa and Latin America experienced similar declines. Currency volatility is one among many barriers to increased lending in local markets for domestic and regional sale. This is where the majority of smallholder farmers globally operate, and yet it represents only a sliver of CSAF lending. Financing domestic value chains to support food security and nutrition is an area where several CSAF members would like to grow if we can mitigate the currency risk. And lastly, many of the businesses we finance lack the systems, processes, and managerial capacity to navigate these exogenous risks. They operate within margins and are often undercapitalized, and as a result, they're vulnerable to even the slightest market shock. Weather and market volatility are challenges for anyone working in agriculture, but they have an amplified effect on the early stage and underdeveloped SMEs that CSAF members target. And that brings me to my final point, and really the upshot of CSAF's learning from 2015. Agriculture is risky, and therefore so is agricultural lending. This shouldn't come as a surprise to anyone on the call. Countries with more developed agricultural sectors have been subsidizing agriculture for decades. And while we as CSAF members firmly believe in market-based approaches to building agricultural value chains and serving their credit as well as capacity building needs, we also recognize the role of targeted subsidy to facilitate increased capital supply. For example, by sharing currency risk or providing downside protection against extreme political or weather events. And likewise, there's a role for targeted subsidy in generating greater credit demand by channeling technical assistance to expand the pool of investment-ready businesses. Karina is going to expand on these points later, so with that, I'll turn it over to Blaine to dive into the data.
Great, thanks, Brian. Good day, everyone, and thanks for joining us. As Brian mentioned, my name is Blaine Stevens, and I work for an organization called MIX, which is celebrating its 15th year of providing data and analytics to promote financial inclusion through platforms like Mix Market and Inclusion Lab. Across the globe, we work with over 2,500 financial service providers of a range of types and sizes, as well as more than 100 investors, donors, networks, regulators, and others seeking to support financial inclusion. This year, and for today's event, we are particularly honored to partner with CSAF to help them understand and track their aggregated portfolio worldwide impact. MIX worked with the 9 lenders of CSAF to collect their portfolio information on their lending and on their borrower businesses. We aggregated, cross-referenced, and normalized data to create a common database, and then anonymize all that information to preserve the confidentiality of the data under our non-disclosure agreements. This serves as the basis for portfolio and market analysis presented to CSAF and presented here publicly for the first time today. The findings from this analysis are particularly compelling and present a really robust view onto the sector, not just of lending trends, but also the factors at play in the major agricultural value chains and in the smallholder producer and other agribusinesses behind them. The analysis is not without limitations, as Brian mentioned before, particularly when aggregating data across lenders with varying reporting practices and definitions. The report presented today and all of its data are robust, and we certainly hope that we'll be able to work with CSAF and the members in the future to present even more information on areas such as portfolio risk and impact in future iterations of this analysis. So with that, let me share some highlights from the analysis. As Brian already pointed out, CSAF members continue to extend their reach and impact. Since 2013, disbursements have grown 75%, from 345 million in 2013 all the way up to 597, nearly 600 million last year. In the next couple of moments now, I'm going to break down these numbers. But before I do that, I want to come back to the point that Brian mentioned before about the businesses that receive this credit. So on the next slide, the chart on the left shows the net growth in borrowers. I want to point out that while the net increase in businesses reached from 2014 to 2015 was 3%, the gross increase in businesses reached, driven by an additional nearly 150 borrowers, was 23%. However, because many businesses reached in 2014 paid down their loans, declined to renew, or had difficulty repaying, as Brian mentioned before, the net percentage increase remained that low 3% I just talked about. Among businesses that borrow from CSAF members, about 2/3, roughly 440, are structured as producer organizations, so farmer cooperatives or farmer associations, with another third being privately owned agribusinesses, such as processors. That's at a global level. When we look at businesses on a regional basis, we find some other interesting trends. For example, in sub-Saharan Africa, about half of the borrowers are structured as private businesses, and this percentage has steadily increased since 2013. So what does the financing going to these businesses look like? The largest share, roughly half, of CSAF loans ranged from $500,000 to $2 million. Meanwhile, a quarter of the CSAF loans were for amounts of less than $250,000. While in aggregate, they account for only 5% of disbursements, these loans, those below $250,000, are usually made to earlier stage businesses, some of which tend to be riskier. Even as these businesses grow and request more credit, it's notable that this share, roughly 25% of loans in this loan size bracket in the CSAF portfolio, is relatively constant from 2013 to 2015. Earlier, Brian mentioned that these businesses were spread across 66 countries. So on the next slide, let me share a bit about where that nearly 600 million was deployed. As you can see from the graphs, the vast majority of this credit was dispersed to borrowers in Central and South America, with sub-Saharan Africa the next largest concentration. Still, there's a lot of variance within these regions. In 2014, so the prior year, Central and South America contributed to over half of the lending growth. However, because of some of the factors that Brian mentioned earlier, especially those related to the coffee sector, lending in these regions slowed in the case of South America and contracted sharply in the case of Central America. We'll come back to some of these America's reasons in just a second. Asia is disproportionately small but rapidly growing region for many of the CSAF members. There, lending increased by 46% last year, driven by strong growth in India, with rice in particular, and Vietnam, with cashews in particular. Together, these two countries account for nearly half of the 67 million dispersed in the region last year. And finally, lending to borrowers in sub-Saharan Africa grew at 9% on a regional basis compared to 2014. This was primarily driven by growth in lending in Uganda's cocoa and coffee sectors, in Ivory Coast's cocoa sector, and in Kenya's tree nut sector. These gains helped to offset significant declines elsewhere, particularly in West Africa, in countries such as Benin, Togo, Ghana, and Mali. Despite these notable changes in the volume of disbursements within each region, the overall distribution of CSAF lending remains similar to that from 2014. This relatively even lending between 2014 and 2015, in part, is due to an increased level of portfolio risk. Portfolio risk at 30 days, which nearly doubled between 2014 and 2015 to over 13% at a global level, and nearly tripling in Central America, due in large part to the factors discussed previously. While we are able to present this standardized view of risk at a very aggregate level, we will continue to work with CSAF on further standardization and reporting definitions and practices to provide even more nuanced view in future iterations. Now I'd like to highlight some notable commodity-specific trends when we look at the lending compared to the previous years. First, I'll start with the most financed commodity among CSAF lenders, coffee. As in previous years, CSAF lenders are heavily concentrated in the coffee sector, which accounted for 46% of global disbursements in 2015, which is down from 55% in 2014. This concentration varies by region. For example, 85% of disbursements in Central America are in the coffee sector, to less than roughly 35% of disbursements in Sub-Saharan Africa. But because of that concentration, lending to the coffee sector has a significant influence on overall CSAF annual performance. For example, when you remove coffee loans from the data set, lending actually grew by 27% year over year, rather than the 5% growth that we mentioned earlier. In 2014, the coffee sector accounted for the most lending growth, surging by nearly 70%. But this year is different. Global disbursements to coffee sector businesses contracted by 12%. The drivers of this decline in coffee lending vary. At a macro level, most lenders cite the prolonged period of low coffee prices and the outbreak of coffee leaf rust disease, as we talked about before. In 2015, decreases in the coffee sector lending were particularly acute in Peru, Honduras, and Mexico. So Peru first. Peru is the largest coffee market for CSAF lenders, accounting for roughly 1/4 of CSAF's global coffee disbursements. Lenders reported a 22% decline in 2015 disbursements and shared that businesses in Peru have struggled with the ongoing outbreak of the coffee leaf rust, especially in those regions located in the Central Highlands. In addition, shifting procurement trends among large international coffee buyers has also had an impact on demand for credit among these businesses. In Honduras, in Central America, virtually all CSAF lending is concentrated in coffee, and disbursements there declined by 40%, from 64 million in 2014 to 39 million in 2015, due again in part to heightened security and country risk. And then Mexico. Despite the net addition of 2 borrowers in 2015, the volume of disbursements declined also by 40%, from 15 million in 2014 to 9 million in 2015, on lower demand due in large part to the impact of coffee leaf rust diseases. Staying on coffee for just a moment more, I do want to highlight 3 notable growth trends in coffee. First, lending to Colombia's coffee sector has grown by 70%, as the country's overall coffee production has rebounded from earlier lows. 2 years ago, CSAF members only lent 3 million to 9 businesses. Last year, lenders supported 22 businesses with more than $22 million in annual financing. Second, similar growth can be seen in Uganda, in Sub-Saharan Africa, where coffee lending has grown from 3 million to 8 borrowers in 2013 to 15 million, nearly 5-fold growth, to 14 borrowers last year. And third, finally, while the absolute amount of credit disbursed is low, we saw a 40% rise in coffee lending in Indonesia, where 5 coffee businesses are now working with CSAF lenders. So let's move on to the next most financed crop in the CSAF portfolio, cocoa. Cocoa is accounted for approximately 10% of global disbursements each year. And in 2015, overall lending to the sector grew by 14% to 67 million, up from 59 in the prior year. This growth in lending occurred alongside a sustained rally in international price of cocoa throughout 2015. Most of this increase can be attributed to CSAF lending in Ivory Coast. As many of you may know, Ivory Coast is the world's largest producer and exporter of cocoa beans. Reflecting this global positioning, nearly 40% of CSAF's global cocoa disbursements went to borrowers there. Cocoa disbursements to 13 businesses during 2015 grew by over 30% to surpass $25 million. Meanwhile, interestingly, there was also a notable increase in cocoa lending in Uganda, where 6 businesses received $11 million in financing last year, a 5-fold increase from the $2 million just the prior year. As a result, cocoa now accounts for 30% of all CSAF lending in Uganda, a country that has not been a traditional exporter or producer of cocoa. I know I'm running short on time, so I want to close by noting that while coffee lending did contract significantly compared to prior year, this decline was offset by cocoa, and as well as other value chains in which lenders are expanding, such as grains, nuts, quinoa, and rice, which were among the fastest growing commodities financed in 2015. In fact, quinoa lending has quadrupled since 2013, and CSAF members dispersed more than $32 million to 13 different quinoa sector businesses last year, up by 40% from the prior year. Much of this took place in Peru, where quinoa has actually surpassed cocoa as the second most financed crop. Another notable growth story is Bolivia's Brazil nuts, or Amazon nut sector. After lending just $3 million in financing each year in 2013 and 14, disbursements jumped 5-fold to $16 million in 2015. And since I just ended with South America, it seems natural to pass the baton over to Karina from Oikocredit, who joins us today from Lima, and who will provide us with a more on-the-ground practitioner perspective and talk more about what these numbers mean in her markets. Karina.
Hello, everyone. As Brian mentioned, I work as an agricultural technical advisor for Oikocredit here in Peru, a country where all the 9 CSAF members are active for some years. And during last year, we altogether provided around $150 million to more than 130 borrowers across 10 crops. Among those businesses is the one pictured here, a well-known coffee cooperative in northern of Peru. As part of my work as an agricultural technical advisor for the Global Agriculture Unit, has given me the opportunity to work hand by hand with the country offices in the ground. So this has given me the opportunity to reflect on how the agricultural market has changed over the past years, especially here in Peru. Despite that we are targeting several agricultural SMEs and cooperatives and associations in this country, and we are very confident that this is the more effective channels to reach small farmers in an integrated way. Many of these businesses have been facing several challenges. For example, many of these cooperatives are undercapitalized and often exhibit limited financial and managerial capacity, which is not necessarily linked with the size of the cooperative or the association. We have seen many very well-known cooperatives to be close to bankruptcy in the last years, either in coffee or cocoa sector, and because of mismanagement, weak financial tools for decision making, and also the impact on price volatility. We also have experienced over the last year the continuous effect of Royal, the coffee leaf ruff, which started in 2014, but it did experience some negative impact in the volume of producing the cooperatives in the ground over the last year. So as part of our annual reporting, all CSAF members participated in a mid-year survey this year, which was the first in our market segment, because we are trying to look how it looks like the 2016 demand for credit. We still altogether think that we're going to experience a moderate to a strong growth, with most lenders estimating between 6 to 10% increase in annual disbursements relative to the $500 $97 million US disbursing last year. Lenders are optimistic that countries with relatively well-developed agricultural sectors, including Colombia, Ivory Coast, Kenya, Peru, Rwanda, and Uganda, will continue to drive much of this growth. There will be continued push towards diversifying into new domestic and global value chains. So lending activity in other countries with large smallholder farmers bases but less stable or less welcoming operating environments, for example, Ethiopia or Nigeria, is expected to remain low until the market conditions become more favorable. This points to the importance to the overall enabling environment, which I will try to touch in a moment. So as more investors and financial services providers take capital into agricultural sectors on emerging markets, CSAF members have come together to identify factors that will help accelerate this growth. This will be explored in more detail in the CSAF annual report, but I would like to highlight a few of these factors here. First, we of course need to grow the supply of capital. Considering the opportunities and the constraints and risks that characterize this market, we found that a blend of different types of capital is needed. There is an important role for both public and private investors with a range of risk-return expectations. For instance, national governments and development finance institutions can use their funds to reduce risk and attract more private sector capital. Partial loan guarantees schemes are also an approach to sharing risk that will allow financial institutions to enter into new and riskier markets and offer a wider range of financial solutions. Also, on the supply side, mechanisms for mitigating currency risks that are common in more mature financial markets remain unavailable or cost prohibitive for a lot of SMEs lending. Local currency has been one of the primary barriers slowing the deployment of capital. With more options to provide more local currency financing, we can reach a much larger share of the world's smallholders and support food security. So with this, this is on the supply side, but there is even more significant needs on the demand side when it comes to being available to responsible and sustainable deployed capital. In fact, CSAF members are anonymous in their assessment that binding constraint to significant market growth is the dearth of investable investment. In many ways, the low-hanging fruit has already been picked. This is, the lenders are already working with well-established businesses that are more creditworthy, especially here in Peru. But we know that there are thousands of more SMEs here and around the world that demand capital that are not as developed. These businesses are struggling with financial managerial capacity, with also governments, and with operational and agronomic capacities. And this is not just early stage ventures. We have seen some of the most well-stable and highest revenue business reach the brink of bankruptcy, including here in Peru, as I said before, even after the case of operations. Here is where technical assistance providers can play an essential role. Many of the businesses that request finance need dedicated pre-investment support. Others need ongoing training and capacity building. Then lastly, there are several needs with regard to the overall enabling environment. We are not in the businesses of telling national governments what to do, but we do know that it's a lot easier to work in some countries than others. Issues, for example, like contract enforcement or consistent tax policy, and whether or not our country allows foreign institutions to make loans at all, can either promote or constrain access to finance and the development on the stable and inclusive financial market for agri-SMEs and smallholders. So for getting sustainable data, we have been working closely with the Initiative for Small Farmers Finance, which is spun out by Dalbert several years ago, and that has done a lot of work to help us to understand these issues of supply, demand, and enable environment. CSAF members are not alone in this assessment of what is needed to responsibly grow this market. With that, I would like to pass this over to Dan to discuss what he has seen in the broader market.
Great, thank you. Thank you, Karina. Hi, this is Dan Zook. I'm the Director of Investments at the Initiative for Smallholder Finance, also known as ISF. The ISF is, we're a multi-donor and investor platform to promote access to finance for smallholder farmers. This typically involves intermediating and building partnerships among financial institutions and various other types of private and philanthropic funders. And we do all this activity backed by deep research that we've pursued for the last several years in the sector. We're supported and advised by a number of the leading funders and investors and practitioners in the smallholder finance sector, all of whom you see on the page here. We're not a member of CSAF, but we've been a knowledge partner to CSAF for quite some years. And in fact, we carried out this data consolidation exercise the last couple of years until Mix took over this year. First, I just want to really strongly endorse this exercise and congratulate the CSAF members for continuing to pursue this data consolidation exercise. You know, at ISF, we're always calling for more information and data sharing in the sector, and I think this is just a fantastic example of what you can achieve in a pre-competitive environment when you have actors who are willing to share data and coordinate with one another. We're also excited to see the launch of the Propagate network among some of the direct-to-farmer microfinance institutions that are getting into agriculture. And so we hope to see bigger and broader alliances across the sector to share information and establish common standards. You know, over the last couple of years, it's been great to see how the CSAF members have expanded across commodities and expanded their reach across geographies. But I think this year also really highlights the challenges of working in agriculture, where the market and climatic forces can have significant business impact. And so we've seen this year is, you know, more modest growth than in past years and a bit of a retrenching as the CSAF members face increased risk in the marketplace. And this is a bit worrisome given the scale of the challenge that we face. Just to put the scale of the challenge in context, the ISF and the Rural and Agriculture Finance Loaning Lab just recently released a new report, a State of the Sector report titled Inflection Point. You can download this either from our website or from the RAF Learning website to go into more detail. But just to touch on a couple of the key messages there, really the key message in the report is that there's still a large financing gap to close for smallholder farmers. We estimate the financing needs for farmers in Latin America, Sub-Saharan Africa, and South and Southeast Asia exceeds $200 billion, of which less than $60 billion is currently available. Now that, you know, $60 billion, the CSAF members are currently providing about $500 million of that, but they're an important stakeholder group in that amount because they're pushing the frontier forward amongst some of the more vulnerable customers. Another thing we found in the report was that the current projected growth of many of the actors in this space is about 7% per year, which is very similar to what as Karina said, the CSAF members are projecting in future years, which in our estimate is not enough to close the gap. You know, as an industry, we need to accelerate that growth rate, and at the ISF, we'd like to see a doubling of that growth rate from 7% to 14% or more. And in the Inflection Point report, we laid out a couple of themes for how we think the industry can work together to accelerate the growth. The first of these themes is smart subsidy, seeing blended structures that can unlock capital that's better aligned to the needs of the leading financial service providers in agriculture. The second is progressive partnerships that share costs and distribute risks among multiple parties, including financial institutions, value chain actors, and NGOs. And the third theme is customer-centric product design that's anchored in the specific needs of farmers, in particular commodities and geographies. And we found in the release of this report, the smart subsidy theme resonated particularly loudly. And there's really been broad recognition that finance and markets are a powerful tool in agriculture, but that the margins, even on the best models, are low and the risks are very high. And you see that in the results from the CSAF members. As we've been continuing our conversations, we've been hearing some demand from donors and practitioners to take this idea of smart subsidy into action. And so we've been starting to circle around a concept of what a smart subsidy fund could look like, a fund that would, you know, its core be intended to unlock other sources of capital and accelerate growth. This will clearly require blended finance with grants or concessional loans mixed with market rate financing, and could include also guarantees or insurance products. We also heard a lot of requests for support in managing FX risk, foreign exchange risk. You heard from Karina and Brian and Blaine highlighted that is one of the key risks, and there was a huge, a number of markets had large movements in their FX this year, and that was a hit to a number of the CSAF members. It's particularly hard to do local lending for the CSAF members when the currency markets are so risky. We recently argued in a briefing note that until the currencies in these markets are more liquid, it's going to require support and subsidy to hedge FX. Finally, there's also a big need for indirect subsidy in the form of training and technical assistance to create and strengthen the SMEs and producer organizations that the CSAF members serve. Many of the better managed producer organizations are already served by CSAF, so the next wave is going to be to reach the smaller or less well-managed or new producer organizations and SMEs. And it's very difficult to incorporate that cost of training and capacity building into these lending models when the margins are so slim. One final point that I'd like to make is that we also think there's a large and emerging opportunity in climate-smart agriculture, and that could be asset financing for technologies. We also think there's an opportunity to blend conservation financing structures with agriculture financing structures. In fact, we're planning to do some research on this over the summer, and we'll release a perspective on that in this fall, so stay tuned. And finally, I'd just like to issue an invitation for those of you who want to put capital to work but are still looking for a smart way to do it in collaboration with others. You know, the ISF is here to help inform funders and bring together partnerships and innovative structures, so feel free to reach out to us. You can reach us through the Initiative for Smallholder Finance website. With that, I'll turn over to Brian for a Q&A.
Great, thank you, Dan, and Karina and Blaine as well. So we've received a couple of questions, and we want to remind others to submit them via the chat or at info@csaf.net. The first question is for Blaine, and Mix has a lot of experience analyzing data and distilling insights for the microfinance sector. Could you comment on how the CSAF data compares to where the microfinance sector is today?
Yeah, thanks, Brian. You know, I think it's really interesting to look at the state of evolution of the sector in the smallholder ag finance sector compared with microfinance from a couple of perspectives. And I'll look at this from the cross-border investor perspective. And if I look at sort of the amount of money being lent and the volume of portfolio, and I'll compare that back to the little bit, you know, just south of $1 billion range, and think of the level of sophistication of reporting at that stage in microfinance, I think from that perspective on the basic data, we're really more or less on par with where microfinance was there, or we have the high-level framework agreed upon. A lot of the top-level numbers and data going into them are relatively consistent, but there's still some further refinements to do. For example, being able to look a little bit more deeply inside of value chains and classification of borrower businesses by typology to dig a little bit more deeply into the dynamics in those sectors. I'd say that the microfinance space, when it was at that same level of investment, was about the same place. But interestingly enough, I find that with the work that CSAF has done and already with the reports that have come out over the last couple of years and the work that the lenders are doing, there's already a much greater focus on the impact metrics. So knowing more about the borrower businesses, classifying, in this case, understanding the participation of females in the value chain, looking at the average hectare size, things like this that microfinance did not get around to for several years further down. So in some cases, it's probably worth saying that, you know, these are tough questions to deal with, but that CSAF is dealing with them early, and it may in some sense be even a little bit ahead of where the microfinance sector was at a similar stage.
Great, thank you, Blaine. A couple questions that I'm going to direct to Karina. So the first is regarding the role of the government in supporting the agricultural sector in Latin America generally and Peru specifically. And the second question is related to Brazil and why there appears to be underrepresentation in CSAF lending into Brazil, which is obviously a very large agricultural market.
Thanks, Brian. Regarding the government role, specifically in Peru, we have seen some participation, especially after the coffee leaf rust at the end of 2014, 2015, with some emergency loans or emergency technical assistance, but it's not a consistent active role from the government. But compare, for example, Peru's role of the government with Colombia, which is a much more, they have a much more structured composition, and they have much more in place technical assistance. We've seen much better results into good agricultural practices within the coffee sector in that country, for example. So in general, the role of governments depends and varies from country to country in Latin America. There are much more stronger, as I said, in Colombia and maybe some in Central America like Costa Rica. But here, particularly in Peru, the government roles has not been so active and so good in terms of giving a much more cohesive and interesting technical assistance and support to coffee farmers. And regarding Brazil, I could say specifically from the oikocredit perspective, this is an important country for growing in the couple of years. We haven't been very active in the coffee sector in this particular country because there's a lot of competition for foreign money in terms of rates. And despite that, I think internally our country office in Brazil is trying to reach a couple of more coffee cooperatives or associations in this particular country. So it is coming up to become an interesting growing country in a couple of years.
And I would just add, from the capital perspective, we've worked previously in Brazil, and there's a set of practical reasons that made it challenging, just linguistic differences, the need to not only have frontline staff who speak Portuguese, but also to have loan documentation and back office staff fluent in Portuguese, but also the role of government subsidy. And this highlights I think Dan spoke to the need for smart subsidy, and subsidy can play a role in both enabling market conditions, market activity. In Brazil, excuse me, there are some government programs that offer subsidized interest rates, and those are attractive to the agricultural businesses that can access them, but they tend to be limited in volume, and many businesses benchmark the price that they're willing to borrow at relative to those subsidized rates, even if they're not widely available, and those rates make it difficult for other lenders, commercial lenders, to operate sustainably. So there's another question regarding the type of financing, the breakdown, working capital loans, CapEx loans. I'll ask Blaine to respond to that question.
Great, thanks, Brian. Yeah, so on this question about where the financing is going in terms of usage, we're seeing pretty broadly across the board, from a disbursements perspective, a very high concentration of working capital or trade credit, somewhere in the range of about 90%, pretty consistent across most regions, maybe a little bit higher in Central America, particularly in the coffee value chain. But looking at from another perspective, sort of long-term perspective, overall outstanding balances, it's about 75-25, so 75 working capital and 25 capital expenditure or equipment. Again, roughly the same across most regions, with a little bit smaller amount towards capital expenditure in Central America.
And I would just add that many of the CSAF lenders have expressed interest and have begun diversifying beyond working capital into CapEx and also long-term loans for crop renovation, rehabilitation in coffee and cocoa. And that appears to be a trend and a broader push among several of the CSAF members. So there's a question now for Dan, which is related to, as you pivot from the research findings into action and are talking to various stakeholders, where do you see the most energy? Is it at the national government level, international donors, investors, buyers? And where do you see the most dynamism in the market?
Yeah, it's a good question. Thanks, Brian. I think it's actually an exciting time because we're seeing it across all of the above, and I think that's what makes this sector really exciting right now, because you've got you do have some large-scale government initiatives and multi-government initiatives. You've got new agriculture strategy from the Africa Development Bank and other development banks. You've got trade corridors. You're also starting to see partnerships emerge among some of the big buyers around the world. You've got the World Food Program with their patient procurement platform, and World Cocoa Foundation doing things in the cocoa sector. So there's a lot of excitement there. And then the microfinance sector is starting to move in here, and you're seeing direct-to-farmer models. There's a huge uptake in digital tools. So I think just across the board, there's just general dynamism, and I think the real challenge is shaping these partnerships and creating these kinds of alliances so that we can share risk and build models across multiple parties, and then figuring out how the best way to layer in these smart subsidies to make these models effective without undermining them by taking all the incentive out.
Thanks, Dan. The next question is for Karina, and it's your outlook on the coffee sector over the next 5 years, especially given that it's such a large portion of current lending by CSAF members.
Thanks, Brian. Coffee sector, especially here in Peru, has many challenges, but I think a few points is for example, aging coffee trees is a fact. So crop renovation is needed in almost everywhere on the coffee production area. And also this is linked strongly with this consistent technical assistance over the first years of renovation, and even when the coffee tree is there. So permanent technical assistance is also an issue for increasing yields. And another issue I think cooperatives and association of coffee farmers have to deal is to have more clarity on the cost of production at farm level, at organization level, and how this can affect the management of pricing, which is volatility is one of the main characteristics of coffee sector. So I think these two combined with the good management practices are the main challenges for the coffee sector in the coming years.
And I would just add a couple points on the market side, on the buyer side. There's been some recent consolidation, particularly in the specialty coffee markets among larger global buyers and specialty players. The CSAF lenders tend to focus on specialty markets, often fair trade, rainforest, organic certified, premium price Arabica coffee. And many of the buyers that have historically sourced from regions like Peru, Central America, are shifting their buying patterns to other regions, including to Southeast Asia. There was also a question, we mentioned Propagate, and a question about to what extent is CSAF coordinating with Propagate, and we are not actively coordinating at this time. We certainly have informal relationships as peers, but Propagate is just getting started, and we hope over time to create more of a dialogue with them, but that's a nascent effort. There's one more question, and then we'll see if any more come in. Otherwise, we'll wrap up the call early. But there's a question related to Asia. It is the fastest growing region, as Blaine noted, but it's also disproportionately small relative to the number of farmers there. And why is that? And so there's some historic factors, just simply that most of the CSAF members began operating in Latin America and or Africa, and are now expanding to other regions, and Asia is among them. Asia presents a lot of diverse cultures, languages, requires a more tailored approach than a region like Latin America that can be served a little more easily in a more streamlined fashion. There also has historically been heavy government involvement in countries like India. There are restrictions on foreign domiciled lenders and a requirement that lending institutions register in country. In some of the Southeastern Asian countries, there are restrictions on offshore lending or heavy government subsidy of the agricultural sector. So those have been historic factors. Some of them are starting to change. Certainly a country like Indonesia that is a large global producer of coffee, cocoa, cashews, a number of other crops that CSAF members finance appears poised for growth. So we have, I think, run out of your questions, and thank you very much for submitting them. Please send any follow-up questions to info@csaf.net. We'll try to address all these questions in the forthcoming report that we plan to release late next week. It'll go out via email and also be available on the CSAF website, www.csaf.net, as well as a recording for the conversation. So thank you to everyone, and particularly to Blaine, Karina, and Dan for their presentations. And we look forward to your feedback. Take care.